Well, do you think rate hikes are going to push us into a recession?
Well, so the only thing that rate hikes can really control here, because all the inflation we're seeing is two main things. One is there's all the fiscal stimulus, so it's more money in the system. And number two, you have supply side inflation, so commodity shortages, supply chain problems, add a war to the mix. And so the Fed, they can't print oil, they can't print copper, they can't fix supply chains. So all that they can really do is try to reduce demand, which risks putting you into a recession. I think their clear mandate is to try to tighten. And the hard part for them is that they've a horrible track record of tightening into a decelerating economy, right? So if they tighten while PMIs are rising, they generally have a better shot of getting some decent gains there. Whereas if they're trying to tighten into a slowing economy, that's kind of the recipe for disaster. That's kind of when you ran into in late 2018. And so they're kind of running in that same environment now, but of course inflation is much higher. So I don't know exactly how far they're going to get, but I'm going to take the under on whatever consensus is for how far they're going to get. So basically everything else besides employment is the funny thing. So that's kind of a lagging indicator.
I see.
And so, for example, if we look at purchasing managers indices, that's probably the cleanest one to look at because it directly measures rate of change.
Yeah.
And you see that peaked back in 2021. It's kind of rolling over. And you're still in positive growth territory, but you're decelerating at a pretty rapid rate.
Right.
So that's number one. Number two is if you look at consumer sentiment, like surveys, like for example, Michigan consumer sentiment, it's at almost like lows not seen since 2009, right? So you obviously had a drop in March 2020. Then you had a bounce when you had all the stimulus and opening back up. But then that sentiment rolled over to new lows for this cycle, despite the fact that employment is unemployment is super low. And one thing to keep in mind is that even though workers are finally getting wages and unemployment is pretty low, inflation's higher than the average wage increase. So part of why it's so troubling is that on one hand you have an overheating economy, but on the other hand people are not really feeling it.
Yeah.
And so I think that we're starting to see signs of decelerating. I mean, I think that's contributing, but that was already happening before the war.
Okay.
Right? So now, I mean, everything complicates it. So lockdowns in China complicate it. Europe complicates it.
Right.
All of that is a shock to the system. But you were actually already rolling over back in 2021. And so, Bitcoin has a tendency to kind of see these things coming because it's kind of liquidity. ARC rolled over. A lot of these things kind of rolled over, and you start to see PMI roll over. And so we are starting to see across the board, there's actually a lot of slowing indicators, despite the fact that at the very moment, if you look at over the prior expansion period, right? So a decade-long expansion, you had like 3 mini cycles in there. You had rising, declining PMIs roughly on 3-year periods.
Yeah.
And so you had these slowdowns that did not necessarily result in recessions. This one's a little trickier because we do also have yield curves inverted for a period of time. Some percentage of the yield curve is inverted. So there are kind of more recession indicators this time, but we're still in that period where we're dipping. It's unclear if it's going to manifest an actual recession or if we're going to kind of dip and then have a rising period out of this. If you look at Atlanta Fed, GDP now forecast, last I looked, they were looking at something like 1% real growth annualized for this quarter. So there are a lot of things that look slow. And I think as you look out maybe 6 months, the question is this kind of a valley, higher growth thing? I don't think we have enough data to say for sure yet, but it's not looking fantastic at the moment.
Well, do you think rate hikes are going to push us into a recession?
Well, so the only thing that rate hikes can really control here, because all the inflation we're seeing is two main things. One is there's all the fiscal stimulus, so it's more money in the system. And number two, you have supply side inflation, so commodity shortages, supply chain problems, add a war to the mix. And so the Fed, they can't print oil, they can't print copper, they can't fix supply chains. So all that they can really do is try to reduce demand, which risks putting you into a recession. Right. It's kind of that whole game of they want to slow down demand, maybe soften it, get a dip, but they don't really want to cause a recession. So that could certainly give a shock to the system, a deflationary shock. But I think the inflationary pressures are deeper than that. I don't think the Fed's tools really, especially given how high debt levels are, that they really have the tools to properly fight inflation. I think it's more of a fiscal problem, and it's more of just how we've structured supply chains. I think that this is only going to be resolved by improving supply chains, improving commodity capex, kind of the real world changes, and those are not quick changes. But one thing I caution people on is that for example, I'm staying in the inflationary camp. Before the war, I was expecting maybe like a localized top in inflation. So we've obviously added fuel to that fire. but I don't really expect inflation necessarily to be a straight line.
Yeah.
I think that we're going to be in a very inflationary decade compared to the prior decade at least. But even I'm still anticipating eventually slowdowns in inflation. Maybe the Fed gets a handle of it for a period of time, but then they end up having to loosen because they go too far. You have a recession, and then they cut, and then you get another round of inflation.
That's right.
So in the 70s, you saw multiple rounds of inflation. In the 40s, you saw multiple rounds of inflation. These things tend to come in bursts. One of the worst things for re-election is high inflation and low consumer sentiment.
That's right.
Which is what the Biden administration is facing, which is what Congress is facing. So on one hand, you want them to control inflation, but it's like you can't always have what you want. If you have this high of a debt level, and if you have these structural problems with the supply chains and your commodities and your economy, and so you're kind of stuck between a rock and a hard place. And I think the Minsky moment comes when the Fed eventually breaks something with their tightening, and yet inflation's still here. Until about a month ago, my answer would have been that I see kind of inflation maybe sort of peaking out around here, at least locally, despite the fact that I still had a long-term inflationary bias. I was kind of setting expectations to maybe start stabilizing. The war certainly added a lot of complexity to the mix. So now, part of an inflationary outlook has to be like, what is Putin going to do? What is Europe going to do, right? So there's this huge amount of variance. I think I'm going to stick to my view that we're going to have these pullback periods, either due to central banks trying to tighten and kind of putting us in a recession, or just supply, oil opens up again, oil price kind of stabilizes, you kind of get a period of stabilization in inflation. So I think inflation's here to stay longer term. I just don't have a high conviction about, say, any 6-month period, because that's kind of a geopolitical question.
Right.
But I'm bullish on Latin America for the most part. I'm bullish on gold. I'm bullish on Bitcoin. Basically that kind of more commodity-oriented space, as well as the value stock space. So, for example, in this kind of recent market turbulence, you've seen healthcare stocks hold up pretty well. You've seen energy pipelines hold up pretty well. They're less tied to the energy price. And so I like assets like that, real assets and value assets. One of the things that we're seeing now, so for example, the dollar index is going up. It's very strong.
Right.
But there's very a lack of breadth to it. So for example, it's more about that the euro and the yen are being very weak right now.
Yes.
So for example, if you compare the dollar to the yuan's actually been strengthening relative to the dollar over the past year or so. There's a huge divergence between dollar yuan versus dollar index. And same thing, if you look over, say, year to date, the Brazilian real's doing great as far as emerging market currencies go. So really, the dollar's not been particularly strong versus many emerging market currencies. It's mostly against those big two, developed markets. And so I'm kind of neutral on the dollar indexes overall, mostly because Europe has an acute energy crisis. Japan also is doing formal yield curve control, and so those are very currency negative. But I'm not particularly bullish on the dollar as it relates to emerging markets, which is why I'm somewhat favorable towards a number of emerging markets. Historically, if you look at rising and falling PMI environments, most of Bitcoin's bull run activity occurs during rising PMI environments.
Yes.
So you have favorable liquidity, you have risk-on behavior. Bitcoin tends to do very well.
Yes.
In declining PMI environments, that's when Bitcoin has historically suffered.
Right.
But what's new is that Bitcoin's never really encountered a stagflationary environment in major developed markets.
Yes.
Right. So that's a whole new variable.